Hello guys, welcome to our channel TechnoUniverse. This is the year when relief may be on the way for consumers who have discovered that higher insurance is just one of the costs that make electric cars more difficult to love. Tesla claims that its company-backed insurance, which is currently available in only 5 states, could expand to 45 by the end of the year. On the other hand, GM, which launched its old GMAC insurance unit as OnStar Insurance in 2020, expects to generate $6 billion in annual insurance revenue by the end of the decade. For EV manufacturers such as Tesla and GM, driver performance data and algorithms running inside the vehicles are creating a new insurance market. EV makers say that they are being motivated by the opportunity to close the insurance gap with more data. The idea is that because so much more about the cars are being measured, especially as automakers use EVs as testbeds for systems aimed at fully self-driving vehicles, insurers will have much better data about the risk each driver poses and will be able to use it to keep costs down. Auto insurance is unlikely to ever be the company's largest business or even close to it. However, insurance is shaping up to be a way for automakers' finance departments to help drive innovation and adoption easier as data generated by cars is captured to lower insurance prices and automakers' hope cement customer loyalty. According to CFRA research analyst Garrett Nelson, EVs are expensive to insure because their off-the-line speed makes traditional insurers wary. And partly because relatively few mechanics know how to fix them, they can be expensive to repair after an accident. Tesla is more comfortable with its vehicles, Nelson said, and they've created a trend. GM and others are looking at the same thing. For the vast majority of Tesla Incorporated investors, electric vehicle sales are the significant figures on the company's balance sheet. However, if Tesla CEO Elon Musk is to be believed, another aspect of the company's operations could account for a significant chunk of its profits. During an October 2020 earnings call, Musk suggested that the company's insurance business, launched the previous year, could account for between 30% and 40% of the overall future value of its car business. At Tesla's current $1 trillion plus valuation, that means the insurance business could be worth as much as $300 billion to $400 billion in the coming years. With a worth of $288.4 billion and average annual growth rates of 2.7% in the past 5 years, auto insurance is an attractive industry. Tesla entered the business in 2019 in California as a broker for policies underwritten by state and national insurance company. Since then, the company has grown its operations and launched a similar product in Texas and Illinois. Tesla has also applied to offer insurance coverage to customers in Washington, and it launched an insurance broking firm in China in August 2020. At Tesla, the insurance is now available in Florida, Texas, Illinois, Ohio, and California. The company hopes to have its coverage available to 80% of U.S. customers by the end of the year, Chief Financial Officer Zach Kirkhorn said during the company's latest earnings conference call last month, though state insurance regulations are a factor. Wedbush analyst Dan Ive says Tesla could insure 300,000 cars by 2025. This is a 2024 to 25 initiative, but they are laying the foundation, Ive said. The company boasted about its early success in Texas, where it launched last fall. Kirkhorn said the cars sent Tesla so much information about how they are being driven, letting the company send guidance back to drivers that the real-time feedback results in quite a bit lower accident rates. If they drive safe, their insurance cost is less, so they drive safer, Elon Musk said. It encourages Tesla insurance with informatics, and real-time feedback encourages safer driving and rewards it monetarily. It's great. In addition to generating revenue for the company, providing auto insurance to customers helps the electric car maker resolve 2 problems at a similar time. First, it moderates the overall cost of insurance for Tesla vehicles. According to the 2018 USA Today survey, ranked the Tesla Model S as the most expensive car to insure. The Model 3's insurance costs Tesla's mass-market vehicles are also more expensive than the industry standard. The second point, which is related to the first, is that Tesla's insurance business has the potential to increase sales by lowering the overall cost of ownership. Monthly premium discounts based on a driver's safety score have been promised by the company. The scores are calculated using real-time driving behavior, monitoring that checks for actions such as aggressive turning, hard braking, and unsafe following distances. For example, drivers with average safety scores can save anywhere from 20% to 40% on their insurance, while those with the highest safety scores can save anywhere from 30% to 60%. GM Insurance. GM, on the other hand, is moving quickly in building on its history of providing insurance. GM Auto Company currently offers traditional insurance in 46 states and Washington, D.C. However, it is working on a safe driving behavior algorithm with American Family Insurance with the hope of incorporating it into insurance offerings beginning in Arizona, Illinois, and Michigan. Introduction in those 3 states will be the start of what a GM spokeswoman said in an email is the company's vision to offer more fair, personalized insurance product to our customers. It is awaiting state regulatory approval for data systems developed by GM and American Family, which it anticipates receiving in the first half of 2022. Because of its partnership with American Family, it is launching faster in those states, but the current product is similar to what you can find on the market today from other insurers. GM is the agent, with American Family Insurance underwriting the policies. One big opportunity is to get insurance clients without adding to the $10 billion yearly spent on U.S. car insurance advertising, said Andrew Rose, president of GM's OnStar Insurance unit and vice president for insurance innovation. That is more than auto companies spend advertising cars, he said. GM will be able to process claims faster than usual because they will be handling their insurance and using data generated by the car. Instead of waiting 18 to 25 days to settle claims, GM believes it will often know the extent of damage almost immediately and be able to settle claims quickly. In claims, cycle time is money, he said. We can know sometimes in seconds, but it may not be time to tell you while the airbag is still deployed. While Rose claims that systems like the one GM are developing provide a lot more data, traditional insurers have been using wireless phone apps to move toward telematics for several years, according to CFRA insurance analyst Kathy Seifert. She said, adding that Progressive and Allstate are among the fastest adopters. Over 2 million Allstate customers are enrolled in telematics programs like DriveWise and MileWise. According to David McInnes, Vice President, Telematics and Usage-Based Insurance, 21% of our auto customers are currently enrolled in the plans, and 35% of new Allstate auto customers choose the plans in states where the plans are approved. According to McInnes, the technology uses phone-based technologies such as GPS trails to track braking, speeding over 800 miles per hour, and driving too fast for road conditions, as well as the time of day customers drive and the amount of driving they do. Usage-based car insurer Root went public in late 2020. Insurance startup Lemonade also began offering usage-based insurance last year. Both companies have fared poorly as publicly traded stocks after debuting in the red-hot IPO market of the past few years. GM says car-based systems will be more accurate because the data will come from the car itself and because the car itself can track factors like seatbelt usage that cell phones can't. At Tesla, the insurance business will be auxiliary in the short and medium term, I've said, and will be more important for encouraging the purchase of electric vehicles than as a separate profit center. Its true significance will be determined by how quickly truly autonomous cars are developed, presenting a safer risk profile that will allow the company to provide coverage as part of a larger fusion of hardware and software, similar to Apple's well-known ecosystem approach, I've said. The goal is to be 30 to 40% cheaper for insurance. I've said that is the end game. So that's a wrap for today. Thank you for watching. If you would like to receive updates about more tech-related news, do not forget to like and subscribe to the channel and hit the bell icon for more updates. In your opinion, will Tesla be able to offer insurance in 45 states this year? Thank you for staying with us.